Welcome to The Explainer. Man, what a week we just had. The markets gave us an absolute roller coaster of data to unpack, and we're going to sort through the whole shebang. We're journeying together from some frankly terrifying macro fears right down to the structural saviors that are quietly reshaping the market underneath the surface. The time to buy is when there's blood in the streets, even if the blood is your own. I know, it sounds super dramatic, right? But honestly, it kind of captures the mood out there perfectly. After 6 straight weeks of market gains, the S&P's suddenly pulled back 1.4%. It snapped that winning streak and gave investors a very serious reality check. But what actually caused this sudden shift? Let's figure it out. Okay, let's dive right into this. Here's our roadmap for today. First up, we'll do a macro reality check. Then we'll look at oil, war, and Devon. After that, how crypto is going institutional. And finally, the big one, the Nvidia season finale. All right, part 1, the macro reality check. Let's look at the terrifying headline data that basically made the market blink this week. 3.8%. Boom. That's the April Consumer Price Index print. And wow, it is the hottest we've seen in nearly 3 years. You see, the market was essentially pricing in this perfect Goldilocks scenario. Strong jobs, cooling wages, containable inflation. Well, this single number absolutely shattered that illusion. It essentially told investors, hey, inflation is running the wrong way. And you better believe the bond market reacted instantly. The 10-year Treasury yield spiked right up to 4.54%. That is literally its highest level of 2026 so far, and it creates a direct, undeniable mathematical headwind for high-multiple tech stocks. And just to make things even more complicated, we had a really tight 54-45 Senate confirmation vote for the new Fed chair, Kevin Warsh. This was the most divisive Fed chair confirmation vote in modern history. So right when the market desperately needed stability to digest that hot CPI data, we got a massive injection of political and policy uncertainty instead. But hey, let's actually deconstruct that 3.8% CPI print. Because sure, the headline is scary, but the details tell a much more nuanced story. Over 40% of that massive increase came from a war-driven energy spike. Gasoline alone surged 28.4% year over year. Then you've got this shelter artifact. Because of the government shutdown back in October 2025, the Bureau of Labor Statistics missed some rent data and had to catch up this month. So that's just a one-time statistical math glitch, not a persistent threat. What is a persistent threat, though, and what you really need to take away from this, is the drop in real wages. They slipped 0.5%. For the first time in years, American workers' paychecks are literally buying less. That eroding purchasing power, that's the real economic danger hiding inside this report. So, what does a new Fed chair actually mean for this inflation reality? Well, Warsh definitely wants to shake things up. He's pushing for a smaller balance sheet and what he calls a regime change. But, the reality of central banking is pretty rigid. Former Chair Powell stays on the board until 2028, hawkish governors are still there, and ultimately Warsh is just one of 12 votes on the committee. He's inheriting a serious inflation problem right as he takes the job. This creates a ton of friction between his desire for immediate policy shifts and the stubborn reality of rising prices that usually demand higher rates. Okay, let's move to part 2 and see how this all builds together. Oil, war, and Devon. Remember that energy spike we just talked about? Well, it's coming straight from the stalled Iran ceasefire talks over in Islamabad. Transit disputes in the Gulf are just dragging on, leaving a staggering 170 million barrels of oil backlogged and waiting to clear. This acts like a persistent, low-grade geopolitical anxiety hanging over everything. Oil essentially acts as the market's live scoreboard for war risk, and with WTI crude jumping back over $100 a barrel, that scoreboard is flashing bright red right now. So how exactly do you navigate this kind of risk? You look for what we call portfolio ballast. A great example here is Devon Energy. They just completed a massive merger with Katerra in May, creating this massive $57 billion independent operator. If oil stays above $90, they are printing huge free cash flow to fuel an $8 billion buyback. And honestly, even if peace breaks out and oil drops back to $70, they have the scale and low production cost to survive it. It's kind of perfectly positioned for this exact macro storm, and it's trading at a really cheap 13.7 times trailing earnings. But here's the truly brilliant part. Devon pioneered this thing called a fixed plus variable dividend. Let me translate that into plain English for you. You get a guaranteed base payout of 32 cents a quarter no matter what. But when oil prices run hot, like they absolutely are right now, they pass that extra free cash flow directly back to you as a variable dividend. Right now, they're paying investors an estimated 8 to 12% total annual yield. It's literally a patience payment that rewards you handsomely while you sit back and wait out the market volatility. All right, moving right along to part 3. Crypto goes institutional. Because while the macro world looks completely chaotic, digital assets are quietly evolving in a massive structural way. There's this totally fascinating divide happening in the crypto world right now. If you're just glancing at the short-term headlines, well, it looks pretty painful. Bitcoin lost its 80K breakout because of that hot CPI we talked about, dropping back to 78K. Ethereum dropped over 5%. We saw ETF outflows. It looks bad. But look at the underlying long-term plumbing being built by institutions. It's staggering. BlackRock is building tokenized cash on Ethereum. Coinbase is launching massive loans backed by Solana. Amazon and Google are testing stablecoins for AI agent payments. The foundation is getting incredibly strong. And this brilliantly illustrates exactly what I'm talking about. Charles Schwab, a literal $12 trillion brokerage giant, is now officially recommending a 7% Bitcoin allocation for aggressive retirement portfolios. Think about that for a second. The platform where most American retirement accounts actually live is bringing crypto right through the front door. That creates massive, undeniable structural demand. Basically, traditional finance is fully merging with decentralized finance. I mean, when you can use Solana as collateral for a $100,000 loan on Coinbase to go buy a house, yeah, the game has officially changed. Crypto is no longer just a speculative side quest for day traders. It's actually crossing over into regulated wealth preservation plumbing. Even JP Morgan is treating the sector like mature tech, pointing out that Ethereum needs actual real-world usage metrics to keep up. The whole rulebook is being rewritten in real time, folks. Which brings us to our final act, part 4, the Nvidia season finale. We've looked at all these structural macro forces, but right now everything pivots on the ultimate micro catalyst. Let's map out the week ahead because it is a big one. On Monday, we get the new Fed chair, Warsh, speaking publicly for the very first time. On Tuesday, Walmart reports earnings, which is going to give us the absolute best real-world data on whether all this consumer stress is actually translating into a retail slowdown. And then, Wednesday after the close, the main event, Nvidia's earnings. Now, before we hit Nvidia, take a look at how the broader semiconductor ecosystem is reacting right now. Let's look at Entegris. The source data showed this stock pulling back precisely into a $130 to $135 entry zone, and it bounced perfectly off 134.86. Their management uncertainty is finally resolved with a new CFO stepping in, but right now, Entegris, just like the entire rest of the market, is holding its breath. Its future entirely hinges on what Nvidia says on Wednesday. So the crucial point here is this absolutely staggering number. Meta, Microsoft, Amazon, and Alphabet have straight up told us they are spending between $650 to $700 billion on AI infrastructure. That is a massive pile of money just waiting for validation. Nvidia's job on Wednesday is to show us exactly where that money is going and how fast it's getting there. Which leaves us with a literal billion-dollar question that is going to define the market right now. Will AI capex accelerate, or is it going to pause? If Nvidia's Q2 guidance shows that demand is insatiable, the entire sector reprices higher. But if demand is moderating, the market reprices lower. It's that simple. This single report will dictate the immediate future of the market. So grab your popcorn, keep your eyes glued to the data, and never stop learning. I'll catch you guys next time.